Ms. Morparia, Bharat, Sajjid, once again, a very happy Diwali and thank you for joining us.
To you as well.
Happy Diwali to you as well.
Diwali.
What do you make of the current economic setup? We can endlessly talk about good points and bad points. As journalists, we love to find the fault lines, but I want to hear the CEO's view of the economy.
So I think the macros are phenomenal for India. India could not have written a better text for itself than what's currently playing out in the global economy. Low commodity prices, low inflation has been hugely beneficial for India. What we were all waiting with bated breath, I must admit to you, over the last 18 months is to see a significant pickup in the investment cycle in India, and that has not panned out for a variety of reasons. I would say largely because we still need to see a demand pickup take place in the country. We are seeing first signs of urban consumption increase quite nicely, and eventually that's going to translate into greater investment pickup happening as well, particularly in some of the core infrastructure sectors that we've all been waiting for.
Right, Ms. Morparia, when we started the financial year, the core assumption was that interest rates will come down, investment cycle will pick up, consumption will make a big bang comeback, and corporates, they will start spending. Now, everything has happened, but yet the feel-good factor to invest or to kickstart a capex cycle is not there.
So if you see, the first three have happened, interest rates have come down. We've now seen transmission as well. We've clearly seen urban consumption pick up. So, these things have actually happened. Corporate investment cycle pickup, people actually highlight three reasons as to why that's not happened. One is we are yet to see a big bang demand pickup to take place for them to get that confidence to invest in greenfield. The other is we need relatively easier execution capabilities, so this whole ease of doing business issue. And the third, which a number of my colleagues like to talk about a lot, which I disagree with, is that the corporates are so leveraged that, how are they ever going to invest? I don't think for a good project in India, we've ever been starved of funds. There will be risk capital available for them, there will be credit capital available for them. So I think it's much more the former, and to a second extent, the whole ease of doing business and your ability to execute in time.
Bharat, if I look at the current earnings season, it's hard to get bullish. It's hard to get bullish for a variety of factors. We can pick out a handful of companies and say they've achieved something different, whether it's Dr. Reddy or perhaps a mid-cap IT or one or two auto companies. But in general, or in aggregate basis, numbers are not great.
Yeah, I'd agree with that, Nikunj. I guess, but I guess what is positive is that we've gone into the reporting season with very muted expectations. So the way we see the earnings trajectory pan out is, we're going to probably have a sedate first half where you'll probably have an exit rate of about 3 to 4% for earnings. But I guess going into the second half, there should be room for optimism. Two things really out there. One is, you'll have a much more benign base effect going into the second half. And secondly, I think, you'll have better flow through of lower input costs and interest rates. As Kalpana mentioned, the transmission is just about beginning to happen. You needed the inventory cycle to play out. So the way we look at it, I wouldn't be surprised at all by the end of the fourth quarter if we have an exit rate of about 8 to 10% on earnings.
Sajjid, 2 years ago, Bharat would have made a case that India has great micro and bad macro. Currently, it's the other way around, right? Great macro and poor micro.
You know what they say, micro is just derived macro. So ultimately, these things, we live in the same universe. No, I think we have to give it time. I think just think of what's happened in the last year. We've had this massive terms of trade shock, right, where inflation has gone down. As Kalpana was saying, urban consumption has picked up. And if you look at corporate earnings, Bharat tracks them much more closely. You've seen margins pick up. You've seen raw material costs go down very meaningfully, 6% of sales. The issue is because demand hasn't picked up, much of this has been passed on to the final consumer. The idea is as final demand begins to firm, our expectation is that as capacity utilization rises and margins become more expanded, you will get a pickup in capex. I think it's important to distinguish manufacturing from infrastructure because there are different animals here. Manufacturing is still suffering from weak final demand, either domestic or external, and a lot of global excess capacity, especially in the commodity sector. So that will take some time to work itself out. I think where the opportunity lies is infrastructure, and as Kalpana was alluding to, that's where implementation bottlenecks, power sector reforms, land acquisition, environmental clearances, getting SEBs to buy more power can spark off some public investment-led infrastructure pickup. And to be fair, if you look at the data objectively and carefully over the last 6 months, you are finding that. capital goods production in the IIP, commercial vehicle sales, lending to infrastructure for the first time in many years have all ticked up. So I'm hopeful. We just have to be more patient in India. This is not a T20 match. It's a long 5-day test match.
Fair point, but let me just pour cold water on the bullish argument, which is that in last 12 months, frankly, we've been lucky. We've been lucky on account of global oil prices. Numbers are out in the open that $1 decline, and there is a direct correlation to the GDP boost. What happens now? That one-time kicker is not there.
Great point. We've written about this as recently as last week, where we've said over the last 4 quarters, India's averaged 7.5% growth, which is remarkable given where other emerging markets in the world are. But about 130 basis points of that is this terms of trade shock that got spent by the government and by consumers. So you've got to correct for that going forward. But I would say it's not just good luck. Good luck's been a large part of it. It's also good policy. The fact is the government's got this 1,000 small steps approach, whose gestation period by definition is going to be longer. So you're exactly right that in a world with depressed global demand and no more incremental kick from lower oil prices, I think policy will begin to have to do the heavy lifting. And this is where over the next 12, 18 months, getting a GST bill, getting a bankruptcy law, making sure we reform the power sector, making land acquisition easier, will have to become important drivers of growth.
What do you make of the latest initiative, the initiative to fix all the discoms? The challenge with discoms are two: number one, political and cultural, and then it's financial. So the financial aspect has been taken care of, but the political and the cultural aspect, frankly, that needs some divine intervention.
I think the real initiative that eventually needs to take place is how do you disburse subsidy to a segment that needs a subsidy in power. So similar to what we have done in terms of cooking gas, etc., we've got to figure out a way at the state level where you actually, through the Aadhaar identity or whatever, target that subsidy you want to give to consumers that need that through a cash transfer, and then all of the distribution companies, generating companies, transmission companies all operate at market clearing prices. And we've done that, we've taken very good steps to do that at the central level. I think that now needs to pan out at the state level.
Let me throw in the entire banking aspect, and for a minute, if you wear the cap of your former banker, what do you make of the current problems in the PSU banking system? There is no capital. B, the decline in commodity prices is a serious deterrent for them. Government every time has managed to bail them out by simple capitalization, but that really may not be the way forward.
So I think banking overall, and I'm still a banker, banking overall I think is in for another radical change. We saw a change in banking from the mid-90s to the late 90s with the advent of private sector banks coming in. They completely changed customer delivery. No longer were tellers and branches at the core of a customer delivery, but you had ATMs, internet and call centers. Now it's what I call device-based banking that's going to be the key disruptor. And with Reserve Bank of India's opening up much more for the payment banks, small banks, etc., you're going to see a massive disruption coming place there. And I think the state-owned banks will have to figure out what is the core strength that they can play in this respect. They, as you know, were late catchers really of technology, but finally got to the core banking, etc., and today have technology-enabled platforms. How quickly they now switch the current physical presence that they have in India, and how quickly do they try and bring down that cost of delivery to the clients? What is the niche really that they're looking at? Because other than 5, 6 national champions, all of the others will really play for their strengths. Payment bank are going to ride on technology, the information highway that's available to them in terms of the data access that they have on customers. Small banks are going to play to their core strengths in terms of their existing presence. And there'll be this 6, 7 large all India banks. So each one of the state-owned banks will have to do that. And if they don't do that willy-nilly, you will have to consolidate.
So the large mega trend has been that with each passing day, PSU banks are losing market share, private banks are gaining market share. They are more efficient, they have a better technology platform, better systems in place. So that mega trend, do you think is here to stay?
It has been there for the last 20 years. We were ringing the death knell of public sector banks from the mid-90s to say you've got these private sector banks now. The fact of the matter is they still have 70% of banking. If they are able to reinvent themselves, to play to their core strengths, if they don't, they will have to consolidate.
That's the way forward, Bharat. Now, let's talk about private banks. They are the first port of call if you are investing in India, if you're a money manager, if you're a financial manager. What's your view on private banks? It's hard to get bearish on them, but it's equally hard to get bullish on them because of valuations.
Nikunj, we've been positive, the private sector, particularly the high quality private sector banks for some time, and we don't see any need to change that stance. Because, we've been hearing about elevated valuations since these banks came to the fore in the mid-90s. I mean, they've been expensive, they continue to remain expensive. And I guess what some people don't appreciate here is the power of compounding. I mean, because if you keep growing earnings very regularly at 20 to 25% every year, and you have a market that has very good organic growth prospects, and you have the ability to take market share as well. So it's a very compelling argument in terms of growth. And again, coming to valuations, while some of them may be expensive in terms of price to book, look at them in terms of price to earnings. A lot of them are trading at low to mid-teen multiples. So I think there is a compelling valuation argument even at these levels.
But what drives the market in the short term is sentiment, in the medium term it is liquidity, and in the long term it is earnings. Sentiment is debatable, it could change with the drop of an hat. Let's talk about liquidity. What we've seen in the last 2 months is a great move in the Indian financial savings. Money is coming back to equity as an asset class. For institutional investors, they like India, but they are not investing in India what they've done in previous 3 or 4 years. So what do you make of this change?
See, Nikunj, the way we look at it is, I think, again, too much is being made out of, a couple of months of FII selling. See, first and foremost, we must appreciate that they're massively overweight India. So in terms of positioning, they are where they need to be. I mean, even now, they're 300 basis points overweight on India versus the benchmark. The second thing that I think a lot of people don't appreciate is this year, emerging market funds have seen $52 billion in redemptions, and we've still got inflows, which is a great outcome if you ask me. But I guess, the first point you made is very important. I mean, this is a country which is underinvested in financial assets, particularly equities. So there's a long, long way to go. And I guess, this is going to be really the game changer as we go into the future. Because let's face it, we don't want to be dependent on foreign inflows all the while, because, there will be volatility out there. And so to me, this is a very, very positive trend.
I guess the source of capital clearly, which is global markets, there is volatility there.
Yes.
So foreign capital will be volatile.
You need an offset.
Yes,
and I guess we are very fortunate that that offset is coming at the right time. Given the fact that globally markets seem to be a little tired and seem to be flatlining. In terms of timing, this couldn't be more positive for us.
Is that the mega trend we should focus on, that there has been a reboot, a reset in financial savings? Gold monetization scheme has been launched, which automatically will take care of all the gold imports.
And there are both push and pull factors here, right? I mean, on the one hand, some complain bitterly about real interest rates being positive. We forget that it was the mid-2000s where you had positive real rates that led to a lot of financial reintermediation. Post-Lehman, you had 5 years of sharply negative rates, and we shouldn't have been surprised that money flowed to physical assets, money flowed to gold. So I think the fact that now, whether it's real estate in India or gold globally has become less attractive is one push factor. The fact that real rates are positive is another pull factor. But I think let's not undermine the Prime Minister's scheme. I think the Jan Dhan Yojana for me in the medium term is the big game changer, because that's where you mobilize all the cash under the mattress, so to speak, and you bring much more rural savings into financial assets. And that then goes back to Kalpana's earlier point, because once you have that financial infrastructure in place, you can begin to reboot more and more product subsidies into cash transfers and financial transfers, where the deduplication fiscal savings are huge.
Ms. Morparia, the regime clearly has changed. Last 5 years, we've seen a regime where commodity prices have gone up, interest rates have gone up. Now it's the other way around. The super cycle in commodities over, structurally and cyclically interest rates will come down. So what will change because of that automatically?
Consumption has to go up. And if you just look at the FMCG companies that have reported, and Bharat will talk more to this, but the trend I'm seeing that with commodity prices coming down as much, if you look at your day-to-day usage of products, we, to my mind, have a double benefit. So in rural India, people who've not known the benefits of a toothpaste and a soap, the price point has come down so dramatically that you're seeing penetration across the board. So it's a big volume game. In urban India, because of the sharp price corrections, and companies have passed on a fair amount of that input price reduction, you're actually seeing a move towards premiumization. And I think this really talks about the strength of India. So if you remember 3 or 4 years ago, we were all talking about how dismal the domestic economy is, interest rates were high, commodity prices were high, but our global sectors were doing phenomenally well, right? Whether it was pharma, tech, etc. And India had that diversification. Now that's somewhat muted, but you're still, seeing some of the cyclicals come back in this thing. Similarly, I feel with all the pessimism that we really have on rural India, you're seeing these pockets where you're actually seeing volume growth coming in by sheer first-time penetration, and the upscaling that's taking place in urban India.
Bharat, coming on that point, because clearly the India romance is demographics and consumption.
Yes.
Historically, we've seen that if urban consumption has done well, rural consumption has not done well. There are a variety of factors where rural consumption is under stress, but will they come back in urban consumption? Will that take care of all the problems which are coming from rural consumption?
I guess what happens is initially, you're running to stay in place, because as you rightly pointed out, rural is taking a back seat, and so urban is, having to do the heavy lifting. But I guess, even as far as urban is concerned, we have a long way to go. What we've seen right now is just, a tepid recovery based on, lower inflation, the household budget having expanded, and as Kalpana mentioned, companies passing on the benefit of lower input costs. Down the line, this trend still has a long way to go, because let's face it, job creation is still not happening at the rate we want it to happen. Once that starts happening, you'll get a very meaningful bump up. As far as rural is concerned, I guess, this is a cyclical slowdown. I mean, globally, as Sajjid keeps mentioning, soft commodity prices have corrected very substantially, and we are also not insulated from that. But at some time, this trend is going to start reversing again. And even in terms of government policy, again, there were a lot of distortions that crept in as far as the rural economy was concerned. Those had to be corrected, and they had to be corrected early in the tenure. But that's a 1 year, 2 year process. But again, there's no denying the long-term potential of that place. So I guess the way we see it is you're already seeing a meaningful recovery. This will get legs in the urban side as employment and job creation picks up, and then rural will join the party. Yes, it's a 3 year process, but it's worth waiting for.
But what we've seen in last 3-4 years is that outward-looking sectors, IT, pharma, some of the sectors have done well. Quality has demanded some degree of premium. FMCG companies are trading at historic valuations. Will the basic market behavior change? Do you think it's now time to rotate, come out of quality, some of these outward-looking sectors, and go back to growth cyclicals?
See, Nikunj, for us, it's neither. It's not a question of this or that. I guess you have to look at every investment in an absolute sense, in an isolated sense, and see if it makes sense. Now, we don't view healthcare and IT services as defensive sectors. For us, they are active bets, because there is an opportunity to participate there. I mean, demand environment in the US is remarkably stable. These companies have great skill sets, particularly on the intellectual side. They keep going up the learning curve. The rupee at the end of the day has been a tailwind, not a headwind. So, that's an absolute investment case in itself. So we are not investing there because we like India or because we don't like India. I mean, standalone, the investment case there is compelling. As far as the India story is concerned, depending on cyclicality, various sectors and themes keep coming to the fore, and you have to focus on them.
Sajjid, I'm going to move the scope of the discussion from local factors to global factors, because clearly next 12 months, globally also a lot will change. So let's first talk about the big fear factor, China.
Right.
China is the current center of global volatility. What do you think will happen to China, and what implications it will have on India?
Two things. So I'm going to take a slightly contrarian view. I think there is a real concern about emerging markets more generally, whether it's Brazil or it's Russia. Our sense is that Chinese policymakers have enough ammunition, enough tools to stabilize Chinese growth. Remember, this is a policy-induced slowing. This is a rebalancing of China's growth model from an external model to a domestic consumption model, away from resource guzzling manufacturing towards services. People forget these details, that services growth has been outstripping manufacturing growth for many, many years, and is a much larger share. So our point of view is that already in the fourth quarter, you'll begin to see some stabilization of Chinese growth, which is not to say that in the medium term potential growth doesn't fall. It has gone from 10 to 7. It will continue to move down to about 6% in 4 or 5 years. Most people worry a lot about China. If you're sitting in Brazil, you should worry. You're a big commodity exporter. If you're India, you should in fact, in a way, almost feel like this is a little bit manna from heaven, because you look at the general equilibrium impact. Our exposure to China, both directly in terms of exports and indirectly through other export commodity exporters, is relatively small, with largely a domestic demand market. So to the extent that China slowing and a new growth model away from resource-intensive manufacturing towards services keeps a lid on global commodity prices for the next 3, 4, 5 years, that actually helps India enormously. So what you're going to see is a rotation of growth drivers in India, away from strong export growth like we saw in the mid-2000s, towards domestic demand, towards consumption, and eventually towards investment. So I think a world in which China is not undertaking a hard landing, but is slowing gradually, commodity prices are depressed, and there are no other global shocks, is one in which India does very well. And make one final point. We keep focusing on India's attractiveness from a long-term perspective. You know, in the long run, we're all dead. In the short run, what investors love is that in a world with a lot of global uncertainty, unlike other emerging markets, India looks very, very good. Our fiscal deficit is today 2% of GDP, less than the time of the taper. Real rates are positive, inflation is halved, and the current account deficit, which was $90 billion 3 years ago, is $18 billion for the full year. So if India gets zero portfolio flows from either debt or equity, just get our FDI flows, we will be in a comfortable BOP surplus. That's the attractiveness part, that external sector comfort creates enough space for policymakers domestically, for example, to cut interest rates at a time when Fed's going to be hiking.
Do you think we should not worry about when Fed would move? Enough has been discussed, and this event has been discussed at nauseum. Whenever Fed will move, that will be an indication that the global growth is making a comeback. So we should not worry about flows, rather focus on good
this,
things.
as you know, is probably the longest awaited interest rate hike in the history of financial markets. So I completely agree with that.
Sajjid, this is that time of the year where we get into this forecasting business. What will happen from this Diwali to next Diwali? So let's get a forecast going on interest rate, inflation.
Wow, good one. So this is under the assumption, because who would have assumed last Diwali that you'd have such a dramatic fall in inflation? I think under the assumption that global commodity prices stabilize, inflation is sort of at the 5 to 6% handle, which is our baseline. I think we're close to the rate cutting cycle. Could you get another 25 basis points down the road in the second half? Potentially, but I think that game is now over. I think the policy focus has to be, as you rightly pointed out, in the absence of the oil tailwind, how can we ensure credible fiscal consolidation, and how do you jumpstart other drivers of growth? And I think the one word that I think policymakers should focus on over the next 12 months is infrastructure. If we can make headwinds on public infrastructure, they say supply creates its own demand. A lot of problems that we're talking about in the rural economy, in the urban economy, productivity growth will all get sorted out. So I think that needs to be the focus. And I think the rate cutting environment has enabled some of that infrastructure provision over the next 12 months.
Let me get some closing comments from you, Ms. Morparia. 12 months from now, when we would be engaging on the same forum, discussing the way forward, what kind of market, what kind of economy, and what kind of environment do you think we could be staring at?
I'm actually quite bullish because...
Quite bullish?
Quite bullish.
Okay.
Because if you look at the comments that Sajjid made in terms of a benign commodity cycle, India's continuing to will be a big benefit of that. And we will see demand pick up with the investment cycle kicking in. I'm actually quite bullish.
So be positive, enjoy the Diwali right now, but ultimately better days are coming. That's what we should focus on.
Better days are coming, put more of your money in equities.
That's the punchline I was looking forward for. Ms. Morparia, Bharat, Sajjid, thank you all for joining us, and wish you once again a very happy Diwali.
Like to you as well.
Happy Diwali.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.